I guess what's interesting to me on a day like this, we did have extreme volatility in the crypto space, but it didn't seem to break.
Yeah, honestly, I see the volatility like today, and I don't even get fazed by it anymore. I've been in the space for about 11 years now, so this is kind of just another Wednesday. Yeah, another Wednesday.
All right, so another Wednesday. I mean, it was a lot of volatility here. I think, though, what a lot of people are getting at here, Greg, is that we've seen sort of a new sort of investor class come into this space, particularly over the last year here. So it's not just necessarily, I guess, some of the cowboys who got there early. They understand the volatility. When you look at this new breed of investors that have come in, even including some of the institutions here, what's the general, I guess, how would you sort of talk to these people about the volatility here? Is this here to stay? Is this something they just have to live with? Or are we going through an evolution where we'll see less and less of these types of drawdowns?
I think that's entirely dependent on the narratives that surround the assets. So if the Fed hadn't printed God knows how many trillions of dollars, I don't think we'd see this volatility in Bitcoin. So it's very much cause and effect. I think the volatility will go down a little from here, but the cycle that continually happens in crypto is people build up leverage, they get overconfident, and then they get crushed. And that's just part of the fact that a lot of these assets are extremely speculative. So I think the volatility is going to go down, but it's probably here to stay for a while.
You know, Greg, one thing that Joe was hinting on that I just want to circle back to is you have some stress on the exchanges like a Coinbase or a Binance or whatever, and there are some stresses. Are there signs that those need to be firmed up to be able to handle more volatile days like these?
Well, I think what you're seeing is that those exchanges, they handle the on and off ramp portion of the business very well. But once you're into the trading with these brand new assets, it's hard for them to even keep up with listing all of them. So what you're seeing, and full disclosure, I own some of the tokens that back these protocols I'm about to reference, so I have a bias. But I think you're seeing a shift towards decentralized exchanges. Specifically, Uniswap has really taken off in the last couple of years, if you're familiar with that.
Okay, so let's talk about these decentralized exchanges, decentralized finance, MakerDAO, backer of the stablecoin DAI, which uses over-collateralization to create a coin that roughly trades in line with the dollar. That's all great. It's very cool. The technology is very impressive. I am genuinely impressed when I look at Uniswap and the automated market maker technology and what is done with DAO. But what is it all for? Where is the real world advantage, or is it really just about creating more ways to trade more coins?
No, the real world stuff's finally happening. That's actually my company, RWA. It stands for Real World Asset Company. And in the legacy economy, as we call it, you would just call them assets. But for us, it's anything where the consensus mechanism is not a blockchain, but it is actually the judicial system, that we call a real world asset. And MakerDAO, at least, is in the process of onboarding those assets right now. So we're able to, it's almost a new paradigm because we're able to let people come to the protocol. For instance, a loan originator will come to the protocol, and they'll be able to generate DAI against their existing book of loans. So I think you're seeing immediate real-world utility.
And is that utility, though, and the way that they're using that utility, is the idea here that this becomes something they do in the short term, or are they sticking it out for a longer-term strategy?
I think it's primarily long-term. I mean, what we're seeing is that they're interested in swapping out revolvers and warehouses from their banks. So you're seeing them replace facilities they have with an existing bank and come to a decentralized protocol like MakerDAO, not just because it can offer better rates, because it has better terms.
Explain that more clearly. Who's getting the better rates? Whenever I hear about rates in DeFi, it's like great lending rates and APYs that blow your mind and 80% yields if you're just a level. But what about from a sort of borrower perspective? Are there currently protocols that if I want to borrow money for something, some capital expenditure, a house, a car, a credit card, where I can get something competitive in the DeFi world versus TradFi?
Yeah, so MakerDAO specifically has an extremely low cost of capital for borrowing. This is because MakerDAO generates the liability in the system.
But this is collateralized lending, right?
Yes, it's secured. So I can give you a real example. So there's a borrower called 6S Capital. They approached MakerDAO through our decentralized governance process, and they were able to get voted in a 15 million DAI facility against their assets. Now, their assets are credit tenant leases. So they go out there and they will buy a piece of dirt, they'll build up a store on top of it, and then they'll sign a lease with a retailer. And maybe that whole process takes 6 to 9 months. And in the interim, while it's happening, they put the senior lien to all those assets into a trust, and that trust acts within the will of the maker holders effectively. So their rate, I believe, when they're onboarded is 3%. So I think their legacy cost of capital is much, much higher than that.